Sometimes you come across a chart with a lot of potential, and Atom is one of those charts. Price is still ranging quite close to where the low was formed, and there are some bullish signs on the lower time frames. From where price is now, it is still over 800% to a new all-time high, making it incredibly interesting. Another chart that is very interesting is ICP with the potential of over 2000%, so make sure to check it out at the end of this video in the altcoin playlist. Now on Atom, I am going to cover the weekly time frame as well as the 8-hour time frame, and we're going to start with the bullish scenario on a weekly time frame, where the first leg to the upside here is counted as a wave 1 with internally a 5-wave structure, 1, 2, 3, 4, 5. After wave 1, we want to see a corrective retracement to the downside in a wave 2, which internally is counted as a double zigzag, zigzag in W, sideways structure in X, and another zigzag to the downside in a wave Y. Now off the low, on the lower time frames, we then want to count a couple of 1-2s, 1, 2, 1, 2, 1, 2, and eventually we then expect a large wave 3 to the upside, which either continues straight to new all-time highs, or alternatively, we create a sub-wave 1, a lower degree wave 1, which basically means you have a 1, 2, 1, 2, 1, 2, you get a wave 3 to the upside, the big push, and then it's going to follow up by a couple of wave 4s and wave 5s. After your lower degree wave 1, you then look for a retracement to the downside. Now this would be the end of the bull market, right? This would be then a bear market. And then after your wave 2, you're going to look for a incredible big wave 3 to the upside, as now in the weekly time frame, you create a multi-1-2, 1, 2, 1, 2, and you look for a very large wave 3 to the upside. Now on the lower time frames, as mentioned at the beginning of this video, there are bullish signs. So on the lower time frames here, 8-hour time frame, this is the low on the weekly time frame. You don't want to break this low. Now off the low, we can count a 5-wave structure to the upside, which is our first wave 1. After wave 1, we can count a flat structure ABC to the downside in a wave 2. I have to say though that in this wave C to the downside, we either have overlap between a 1 and a 4, which is an invalidation, but I can get around the overlap, right? If I count a wave 2 over here, and this is the matching wave 4. However, you do then have a 618 touch for wave 4, which is not great, has to be said. Now, after this wave 2, we can then count another 5-wave structure to the upside, which is our second wave 1. So that means that on the 8-hour time frame, we then have a double 1-2. 1, 2, 1, 2, if 2 is finished over here. Mind you that this structure to the downside is counted as a zigzag ABC, and a zigzag to the downside can become a larger corrective structure, but at the moment this is where I place my 2 at the low, and the invalidation therefore is at 4. Now of the low over here, at the moment, we can count a 1, 2, 3, 4 working maybe on a wave 5 to the upside, after which we get another retracement, which could be a very interesting opportunity to join and look for a move towards the upside. Alternatively, this is another 1, 2, 1, 2, and price is now going to start a wave 3 to the upside to higher prices. You would then expect a 1, 2, 1, 2, get a wave 3, 4, 5, 4, 5. That would be the end to create preferably another 1, look for another 2, and then continuation to the upside. Now, if we then go and zoom out and cover the quote-unquote bearish scenario, which is actually still bullish, by the way, then here we would create another low. So the impulse to the upside is the same, it's just that this structure is different. In this particular scenario, we would count this as a triple zigzag. So we have A, B, C, and W, then a short wave X, which is a zigzag, another ABC to the downside in a wave Y, another zigzag up in a wave X, and we are then looking for another wave A, wave B, and a wave C to the downside in a wave Z to create a W, X, Y, X, Z structure. Now a W, X, Y, X, Z is incredibly rare, but that would be the bearish scenario, and an Elliott Wave analyst always needs a bullish and a bearish scenario, right? So in this bearish scenario, preferably still on the lower time frames, you look for a move towards the upside, as I will show on the 8-hour time frame. But then we're going to label that a wave B, and then a wave A, wave B, wave C. To the downside, we also have support that is untouched, which is this point of control here at 2.610, which is the point of control of this bit of the chart here. Preferably, if price would move to the downside, this is going to be the end of your wave Z, and therefore that is going to be your wave 2. Now this, of course, creates an amazing opportunity to look for price to move towards the upside. And what we want to see in this wave C is a 1, 2, maybe another 1, 2, get a 3, and then a couple of 4, 5s that slow down price action as it is approaching the point of control. And when you see this just above support and then you move into support, this is a great opportunity, and it is one of my favorite setups as an Elliott Wave analyst and trader. Now, the invalidation for this scenario is price moving to the upside and taking out this high at 10.683. On the 8-hour time frame, zooming in, we then have to count a corrective structure to the upside, which would be a double zigzag. So in this particular case, we have the impulse to the upside of the low here, but now it's counted as a wave A. This structure here is now counted as a sideways WXY in a wave B. Being a flat structure in an ABC, then we have X and a zigzag in a wave Y. This is then your wave C to the upside to finish wave W. So wave W is a zigzag. The move to the downside over here is now not counted as an impulse as we counted in the bullish scenario, but now it's counted as a double zigzag to the downside. We have wave A, wave B, and then 1, 2, 3, 4, 5 to the downside in a wave C. This is your wave W. Then we have a wave X towards the upside, and after wave X, we have another wave A, wave B, wave C to finish wave Y. Now, therefore, we finish a bigger wave X, W, X, and we look for wave Y. Wave X did retrace deep compared to wave W. If I take a Fibonacci from the start of wave W to the end of wave W, then you can see that price retraced to the 886 Fibonacci, which for a double zigzag wave X is very deep. Preferably in a double zigzag, wave X is not touching the 0.7, which it obviously did, right? And generally, the probabilities are therefore reduced for this scenario, as preferably in a double zigzag, wave X is not touching the 0.7, but it did. It is not an invalidation. Right? The invalidation for a double zigzag is taking out this low, which it didn't. So therefore, we can at least still consider it and talk about it. After wave X, we then want to see another zigzag to the upside in a wave Y, which is then your finished wave A. Potentially here, your finished wave B. Of course, a zigzag can become a larger corrective structure, but at the moment, we count a finished B here. And then we would look for a C towards the upside, still taking out this high, which is the same as the bullish scenario. However, after wave C, you look for price to turn around and move towards the downside. Also, if price moves towards the upside and is going to move beyond the 1.618 trend-based fib extension at 7.793 on my chart, taken from the start to the end of W to the end of X, the probabilities will significantly increase for the bullish scenario compared to counting a bearish scenario here, right? So that is also something to keep in mind. Now we do have some resistance in that area. We have a point of control of this range here at 6.20, which we have to keep an eye on. And we also have some horizontals here. Once again, around 6.23, right? There's a bit of resistance. And also here we have a weekly at 7.342. Now if I then zoom out to show you all of the levels, which you may want to copy on your chart, feel free to, then the point of controls, which are some of my favorite levels, are these ones here. The blue one, by the way, is a value area low of this bit of the chart, right? So these are the point of controls and then a value area low. And then here are the weekly and monthly resistance or support levels that I have on my chart. So then finally, the probabilities. On a, let's say, weekly time frame, right? Monthly, weekly, just a very high time frame, the probabilities are highest for the bulls. Even if you would take out this low again, right? In another ABC to finish wave Z in a bigger wave 2, right? It's still bullish as you would look for price to continue towards the upside. However, we do have to realize that a WXYXZ is a very rare corrective structure. So arguably, it gives some more probabilities to the more bullish scenario where a low is in compared to an unfinished corrective structure, WXYXZ, just because a WXYXZ is so rare, but it is relevant, right? In both cases, you look for price to move up and not take out the low at basically 1. Now, the number 2 position, lower probabilities, is any bearish scenario, which I haven't presented in this video because at the moment they are not relevant. I mean, my quote-unquote bearish scenario is this one here, which in the end is actually still bullish. Now, on the 8-hour time frame, both of the scenarios presented in this video would take out the high here at 5.32. And then we just follow up with what price is doing. Now, as the probabilities on a weekly time frame are higher for a finished WXY at the low, just because an XZ is rare, arguably it increases the probabilities for a multi-1-2 locally, right? And you don't want to move below 3.55. If you take out this low here, right, it's not necessarily a problem because a zigzag, as mentioned, it can become a larger structure. By all means, you don't want to take out this low. And at the moment, I would count a finish low over here. That's just the way that at the moment I label things, right? But here, of course, we look for price to move towards the upside and take out the high. And we want to see strong continuation, potentially creating another wave run, right? 1, 2, 3, 4, 5, lower degree 1, another retracement to move towards the upside, right? Also, in the bullish scenario, we want to move beyond 7.793 just to make sure the bearish scenario has even lower probabilities. In the bearish scenario, we look for the same direction. We look for price to take out at least 5.32. So there's confluence between the two. Now, the biggest difference between the two scenarios is that if price creates an impulse to the upside, right, and it finishes here as a wave 1, that's your 2, 3, 4, and you end with a wave 5, you look for a retracement. The bears want to see a large impulse, or at least a motive wave, like a diagonal, to the downside, right? To get a retracement and another leg down to new lows. Bears want a large impulse or diagonal to the downside. The bulls want to see a 5-wave structure to the upside followed by a corrective retracement and eventually see continuation to the upside. The bulls want a 3-wave structure to the downside. The bears want a 5-wave structure to the downside, right? Keep it simple, step by step, range by range, but this is something you have to take in mind, which is what I write over here. Be very aware after a 5-wave structure to the upside, right? 1, 2, 3, 4, 5-wave structure, that if this finishes, wave C, right, in the bearish scenario, or another 1, 2 in the bullish scenario, okay? After a wave C, you want to see motive waves to the downside. After a wave 1, you want to see corrective waves to the downside and look for continuation, okay? That's the biggest difference. So keep it simple, step by step, range by range. I hope that this video was helpful or valuable to you. On the left, you see the ICP analysis, which I can really recommend. And on the right is the Elliott Wave educational playlist to help you understand more about Elliott waves. Thanks for watching and subscribing, and I hope to see you at the next one. Bye-bye.